You know what nobody's talking about? The fact that we're watching the greatest wealth transfer in modern history happen in real time, and most people have no idea it's even occurring. While everyone's distracted by headlines and political theater, something fundamental is shifting in the global financial system. And if you're not paying attention right now, you're going to wake up one day and realize you missed the window entirely. Let me paint you a picture of what's actually happening behind the scenes. Right now, central banks around the world are buying gold at a pace we haven't seen since 1967. Think about that date for a second. That's right before the entire Bretton Woods system collapsed. That's right before Nixon had to close the gold window because foreign governments were draining Fort Knox. The central bankers knew something was broken then, and they're acting like they know something's broken now. The People's Bank of China just reported their 18th consecutive month of gold purchases. 18 months. But here's what's interesting, and this is where it gets really telling. Western intelligence analysts believe China's actual gold reserves are 3 to 4 times higher than what they're officially reporting. Why would they hide it? Because if the world knew how much gold China actually controlled, it would trigger the very crisis they're preparing for. They're accumulating in silence, building a fortress while everyone else is building houses of cards. Poland just moved 400 tons of gold from the Bank of England back to Warsaw. 400 tons. That's not a minor logistical operation. That's a statement. When you physically repatriate that much gold, you're saying you don't trust the system anymore. You're saying you want your wealth where you can see it, touch it, control it. And Poland's not alone. Hungary, Austria, Germany, they've all been quietly bringing their gold home. These aren't random decisions. These are coordinated moves by people who understand what's coming. But let's talk about what's happening in the physical market, because this is where the story gets really interesting. There's a guy in Singapore, runs one of the largest precious metals vaults in Asia. He told me something a few months ago that stuck with me. He said the premium on physical gold bars has never been higher. Not during the 2008 crisis, not during COVID. Right now, people are paying 2, 3, sometimes 4% over spot just to get their hands on actual metal. And the wait times? 6 to 8 weeks for standard bars. That's not a healthy market. That's a market that's running out of supply. The COMEX, that's the big commodities exchange in New York where gold futures trade. They've got a problem. The ratio of paper gold to physical gold in their vaults is running at about 100 to 1, maybe higher. Nobody knows the exact number because they don't have to disclose it. But think about what that means. For every ounce of actual gold sitting in a vault, there are 100 claims on that same ounce. It's musical chairs, except when the music stops, 99 people are going to be left standing with nothing but a piece of paper that says they own gold. And here's where it gets even more interesting. The big banks, JP Morgan, HSBC, the usual suspects, they've been accumulating physical gold in their own vaults while simultaneously selling paper gold to their clients. Let that sink in. They're telling their retail customers that gold's a barbarous relic, that it doesn't pay dividends, that you should be in stocks and bonds. Meanwhile, they're stacking physical metal like their lives depend on it. When the smart money does the opposite of what they're telling you to do, you should probably pay attention. I want to tell you about something that happened in 1980 that most people have forgotten. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, they tried to corner the silver market. They accumulated so much physical silver that they literally broke the commodities exchange. The price went from $6 an ounce to $50 an ounce in a matter of months. The exchange had to change the rules mid-game to stop them. They implemented position limits, raised margin requirements, basically rewrote the rulebook to prevent the Hunt brothers from taking delivery of the metal they'd bought. Why am I telling you this story? Because the same thing is happening right now with gold, except it's not two billionaire brothers doing it. It's entire nations. It's central banks. It's sovereign wealth funds. And you can't just change the rules on China or Russia or India the way you could on the Hunt brothers. When a foreign government demands delivery of their gold, you either give it to them or you admit the whole system is a fraud. There's no middle ground. The World Gold Council just released data showing that central bank purchases hit a record high last year. But here's what's buried in that report. The category they call unreported purchases. That's gold being bought by central banks who don't want anyone to know they're buying. That category has exploded. It's now bigger than all the reported purchases combined. Think about that. More gold is being bought in secret than in the open. What does that tell you about what these institutions know? Let's talk about the dollar for a minute, because you can't understand what's happening with gold without understanding what's happening with the currency it's priced in. The dollar's been the world's reserve currency since 1944. That's given the United States an extraordinary privilege. We can print money and export our inflation to the rest of the world. We can run massive deficits and someone else pays the price. But that arrangement only works as long as everyone agrees to keep playing the game. Saudi Arabia just announced they're open to selling oil in currencies other than dollars. That's seismic. The petrodollar system has been the foundation of American financial dominance for 50 years. When oil is only sold in dollars, every country needs dollars, which means they need to hold dollar reserves, which means they buy U.S. Treasury bonds, which allows us to borrow at artificially low rates. It's a beautiful system, if you're America. But if that system breaks down, if oil starts trading in yuan or rupees or gold-backed currencies, the entire architecture of global finance shifts overnight. The BRICS nations, Brazil, Russia, India, China, South Africa, they're building an alternative payment system. They're talking about a gold-backed trade currency. Now, you might think that's just talk, just posturing. But these countries represent half the world's population and a third of global GDP. When they start trading with each other outside the dollar system, when they start settling in gold instead of greenbacks, the demand for dollars drops. And when demand for dollars drops, all those trillions we've printed over the last 15 years come flooding back home. That's when inflation stops being a problem and becomes a crisis. I spoke with a currency trader in London last week. He's been in the business for 30 years, traded through every major crisis since Black Monday in 1987. He told me something that chilled me. He said the bid-ask spreads on large gold transactions have widened to levels he's never seen outside of a full-blown panic. What that means in plain English is that it's getting harder and harder to buy or sell large amounts of gold at predictable prices. The market's becoming illiquid. And illiquid markets are fragile markets. They break suddenly and without warning. Now, here's something most people don't understand about gold. It's not really an investment. It's insurance. It's the asset you hold when you don't trust the other assets, when you don't trust the government to maintain the value of the currency, when you don't trust the banks to be solvent, when you don't trust the stock market to reflect reality. Gold is what you own when you think the system itself might be the problem. And right now, trust in the system is evaporating. A recent survey showed that less than 30% of Americans trust the Federal Reserve to manage the economy effectively. Less than 30%. That's a crisis of confidence. And when people lose confidence in the institutions that manage money, they start looking for alternatives. They start looking for something real, something tangible, something that can't be printed or manipulated or devalued by decree. Let me tell you about what happened in Weimar Germany, because there are some uncomfortable parallels to today. In 1918, $1 US bought 4 German marks. By 1923, $1 bought 4 trillion marks. 4 trillion. The currency became so worthless that people used it as wallpaper, as kindling for fires. They'd bring wheelbarrows full of cash to buy a loaf of bread. But here's the thing. The people who owned gold, who owned real assets, they survived. They even thrived. While everyone else's savings evaporated, the gold holders maintained their wealth. They could wait out the crisis and buy assets for pennies on the dollar when it was over. I'm not saying we're headed for Weimar-level hyperinflation, but I am saying that the conditions that led to Weimar, massive government debt, central bank money printing, loss of confidence in institutions, those conditions exist today. Maybe we avoid the worst-case scenario. Maybe the Fed threads the needle and manages a soft landing. But maybe they don't. And if they don't, if this goes sideways, the people who prepared are going to be very glad they did. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. Covers how to get physical gold into your retirement account without triggering tax penalties, how the custodian system works, what the fees look like. Worth checking out if that's relevant to your situation. No pressure, just information. Anyway, back to what's happening in the markets. The gold to silver ratio just hit 90 to 1. That means it takes 90 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. When it gets this stretched, something usually snaps. Either gold comes down or silver catches up. And given everything else we're seeing, the central bank buying, the supply constraints, the geopolitical tensions, I'd bet on silver catching up rather than gold coming down. But here's what's really interesting about silver. It's not just a monetary metal anymore. It's an industrial metal. Every solar panel uses silver. Every electric vehicle uses silver. Every smartphone, every computer, every 5G tower, they all need silver. And we're not mining enough of it to meet demand. The Silver Institute estimates we're running a supply deficit of over 200 million ounces per year. That deficit has to be made up from above-ground stocks, and those stocks are finite. There's a mine in Nevada, one of the largest silver producers in North America. They just announced they're cutting production because the ore grades are declining. It's getting harder and more expensive to extract silver from the ground. And they're not alone. Mines all over the world are facing the same problem. The easy silver has been mined. What's left requires more energy, more capital, more time to extract. That means higher costs, which means higher prices, which means anyone holding silver today is sitting on an asset that's going to become increasingly valuable. Let's talk about what happened in 2011, because I think we're setting up for a similar move. Gold hit $1,900 an ounce in September of that year. Everyone said it was a bubble. Everyone said it couldn't go higher. And then it corrected. Dropped all the way back to 1,100 over the next few years. But here's what people forget. That correction happened because the Fed convinced everyone they had everything under control. They tapered QE. They talked about normalizing rates. They projected confidence and stability. And the market believed them. Fast forward to today. The Fed's balance sheet is still massive. They tried to reduce it and had to stop because the market started breaking. They raised rates and now they're cutting again because the economy can't handle normalized rates anymore. We're trapped. We can't go back to the old normal because the debt load is too high. We can't sustain the new normal because it requires constant intervention. We're stuck in this weird twilight zone where the only option is to keep printing and hope it doesn't blow up. And that's why gold's going higher. Not because of speculation, not because of momentum, because the fundamental structure of the financial system requires constant inflation to function. And gold is the only asset that maintains its purchasing power in an inflationary environment. It's not that gold goes up in value. It's that everything else goes down relative to gold. I want you to think about something. In 1971, when Nixon closed the gold window, gold was $35 an ounce. Today it's over $2,000. That's not because gold became more valuable. It's because the dollar became less valuable. Gold is the constant. It's the measuring stick. It's the thing that shows you how much purchasing power your currency has lost over time. And here's the scary part. We're accelerating. It took 40 years for gold to go from $35 to $1,000. It took another 10 years to go from $1,000 to $2,000. How long until it goes from $2,000 to $4,000? Based on the rate of money printing, based on the trajectory of debt, based on the geopolitical realignment we're seeing, I'd say we're looking at years, not decades. The mining companies know this. That's why their stocks have been outperforming the broader market. Barrick Gold, Newmont, Agnico Eagle, these companies are printing money right now. Their costs are relatively fixed, but the price of their product keeps going up. That's a beautiful business model. And the smart money is piling in. Hedge funds, pension funds, sovereign wealth funds. They're all accumulating positions in gold miners because they understand the leverage. When gold goes up 10%, mining stocks go up 30 or 40%. It's a multiplier effect. But here's the thing about mining stocks. They're still stocks. They're still paper. They're still subject to market crashes, liquidity crises, counterparty risk. If the system really breaks down, if we get a 2008-style credit freeze or worse, those stocks could get hammered even if gold is soaring. That's why you need physical metal. That's why you need something you can hold, something that exists outside the financial system, something that doesn't depend on any institution or government or corporation to maintain its value. There's a concept in risk management called anti-fragility. It was popularized by Nassim Taleb, the guy who wrote The Black Swan. Anti-fragility means you don't just survive chaos. You benefit from it. You get stronger when things break down. Gold is the ultimate anti-fragile asset. When the system is stable, it holds its value. When the system is unstable, it soars. You can't lose with gold. You can only win or win more. And that's what people are starting to understand. That's why premiums are spiking. That's why wait times are extending. That's why central banks are buying at record levels. They're not buying gold because they think it's going to make them rich. They're buying gold because they think everything else might make them poor. I talked to a wealth manager in Switzerland last month. Switzerland, right? The place where rich people have been hiding money for centuries. He told me that his high net worth clients are moving 10 to 20% of their portfolios into physical gold. Not gold ETFs, not gold mining stocks, physical gold stored in private vaults. These are people with 50 million, 100 million, 200 million in assets. They're not worried about making money. They're worried about keeping money, and they've decided that gold is the best way to do that. Think about what that means. The people who have the most to lose, who have access to the best information, who can afford the best advisors, they're buying gold. They're not buying more stocks. They're not buying more bonds. They're buying the thing that's been money for 5,000 years. They're buying the thing that's survived every empire, every currency, every financial system that's ever existed. And here's the kicker. They're doing it quietly. They're not announcing it. They're not bragging about it. They're just accumulating slowly and steadily while the price is still relatively low, because they know that once the crowd figures it out, once the average person realizes what's happening, the price is going to gap up so fast that you won't be able to get in. The window will close. That's what's happening right now. The window is closing. The premiums are rising. The wait times are extending. The supply is tightening. And at some point, maybe next month, maybe next year, but at some point, the price is going to break out in a way that makes the 2011 move look tame. Because this time, it's not just investors buying. It's central banks. It's sovereign nations. It's the entire non-Western world trying to escape the dollar system. When that happens, when gold goes from 2,000 to 3,000 to 5,000, the people who waited are going to be devastated. They're going to watch their purchasing power evaporate while gold holders preserve and grow their wealth. They're going to wonder why they didn't see it coming, why they didn't act when they had the chance. But here's the thing. You still have the chance. The window hasn't closed yet. It's closing, but it's not closed. You can still buy physical gold at reasonable premiums. You can still get delivery in a reasonable time frame. You can still position yourself for what's coming. But you have to act. You have to make the decision. Because once everyone else figures it out, once the panic buying starts, it'll be too late. I'm not trying to scare you. I'm trying to wake you up. I'm trying to show you what the smart money is doing, what the central banks are doing, what the people who understand the system are doing. They're buying gold. They're buying silver. They're getting out of paper and into real assets. And they're doing it now while there's still time. The greatest wealth transfer in history is happening right now. The question is, are you going to be on the right side of it or the wrong side? Are you going to be one of the people who prepared, who saw what was coming and acted? Or are you going to be one of the people who waited too long, who thought they had more time, who believed the system would hold together just a little bit longer? The choice is yours, but the window is closing, and once it shuts, it's not opening again.